Next is cash burn rate. Cash burn rate measures the rate, basically measure how quickly company is using up its cash resources. Yeah, to understand cash burn rate, we need to first understand free cash flows. Okay, so what is free cash flows? Free cash flow is company's cash from operations minus its investment in PP assets or capital investment. For example, cash from operations, we have 10 million and our investment in capital is $5 million. So the free cash flow for this period will be $5 million, meaning the company has discretion to use $5 million cash for any other usages. Okay, then cash burn rate is typically used when the free cash flow is negative. Okay, instead of increasing free cash flow, the company is decreasing free cash flow, then we can calculate the cash burn rate. So the cash burn rate is calculated as free cash flow over the period, which is negative, divided number of days in the period. We can measure number of days or number of weeks, number of months at any period. For any period, we can measure how quickly a company is using up its cash. And together with your the cash balance in your balance sheet, you can figure out how quickly you're going to run out of cash. If you have a huge cash reserve in your cash account, then you don't worry about it. If you don't have many, okay, then you have to worry about it. And cash burn rate is higher, okay, better to increase the source of cash. Either you have to fund equity investment or you have to borrow money from creditors. Right, this rate is typically used for startup companies. Right, a couple of years ago, Tesla experienced its cash crisis. So eventually Elon Musk solved the problems. Right, I believe Elon Musk borrowed a large amount of money. Right here we have some calculations for PepsiCo, but let's move to solvencies. Okay, we have seen liquidities, and let's talk about solvencies. Solvencies measures companies' ability to meet debt obligations. Basically, in the long run, there are two measures. Okay, the debt to equity measure. The debt to equity measure basically measures the relative amount of liabilities compared to equities. Right, high ratios suggest less solvency, because your liabilities is greater than the equities. But be careful. This ratio varies a lot from companies to companies. To compare, we have to make sure that those two companies are comparables. Okay, for example, they're in the same business, the same industries. If they're from different industries, it's difficult to say whether a high ratio is good or bad. Right, next is time interest earned. Measures how much operating profit is available to pay interest. Right? If we couldn't pay interest, then we are default. There's a problem for not paying interest. So time interest earned is earnings before interest and taxes divided by interest expense. Alright, so here's a calculation for PepsiCo. PepsiCo has a debt to equity ratio of 5.9, which is much higher than industry. Retail industry is 1.31. But I think if you want to compare, you need to compare PepsiCo's debt to equity ratio with Coca-Cola's. They are directly comparable. The time interest earned will be 8.2 times, which means PepsiCo has enough money basically to cover interest payment. It's capable of covering those financial costs. Right. Finally, let's take a look at some other ratios. These ratios are also cash flow related. First, we have operating cash flow to capital expenditures. Basically, it measures whether companies is able to replace their PP assets, operating cash flow, if they have enough operating cash flow to cover annual capital expenditures. Another way to express this idea is a free cash flow, which we talk about that operating cash flow less net capital expenditures. A positive free cash flow means company is able to save money for future replacement. Right here we have a graph showing the operating cash flow to capital expenditure, this ratio for 3 companies, and they are directly comparable. You can see overall the CVS is more healthy than the other 2 companies in terms of this ratio, and this ratio is increasing. Okay, that's the end of lecture 4. And just a reminder, a project has been released. In this project, you're going to analyze 2 competing companies. Okay, you'll be asked to discuss industry environment for both companies, right? And you can use a UHV database, the IBIS Word, to find those information about industry environment. So you'll be asked to prepare vertical and horizontal analysis. Okay, explain the differences. Then finally, you'll be asked to calculate ratios. Okay, do ratio analysis for both companies. So make sure you explain the difference similarities between the 2 companies. Right, sample project has been also posted, so you can take a look at the sample project to see what is expected basically for this project.